Hello, everyone. I'm Aviv Handler. I run a small consultancy called ETR Advisory, specialising in regulatory and compliance aspects of commodity trading, energy trading, etc. And there's another title slide. And what I'm going to talk about is a bit about what the future regulatory landscape for commodity trading may look like. I come from the world of more financial style regulations, so things like EMIR, REMIT, MiFID II, those sorts of things. So anti-abuse regulations, regulations that arose out of the banking crash several years ago. So I'm going to focus on those, but we'll talk about other things as well. But that's very much my world. And we're in a very interesting period. So what we're going to think about is, first of all, how did we get here? Why are we in the current regulatory environment that we're in? And how did it go? What do things look like now? And also, how are we dealing with the current situation? You know, as we've heard over the last day and a half, there's quite a lot going on. Let's put it that way. The market is changing. There's lots of people doing lots of things in the market, both because of COVID, because of the war in the Ukraine, and all sorts of other things as well. And so we'll then briefly think about what the future will look like as well, or what it could look like. I think we've also heard that we don't really know what the future looks like. We have no idea what the future looks like, but we can take a bit of a guess based on past events. So, the rules that, or the world that I live in at the moment, where did it all come from? It came from two places. One was the banking crash, what I call the last crisis. So that's now 2 crises ago. We always think about how many crises ago something happened. So we all remember what happened between 2007 and 2009. That led to a whole bunch of rules being created and a great period of lawmaking, which put people like me into business and things like that, but also led to many rules, banking-style rules, many of which applied to some degree or another to the commodity trading industry and the energy trading industry as well. So that's one source. And the second source was really all around market manipulation. There has for a long time been a perception, and perception is very important here, that traders stack the market against the consumer. And here is a picture from the film Trading Places, which some of you may remember, with Eddie Murphy and Dan Aykroyd. And I have a longer presentation about the meaning of this film. I think it came out in 1985, but these are the baddies in the film. And the goodies are Eddie Murphy and Dan Aykroyd. And actually, just to cut a long story short about my longer presentation, what happens in the film is that the goodies triumph by successfully manipulating the market using inside information instead of the baddies. And that was considered to be a good thing in 1985, and that happened as well. So they all had a yacht in the Caribbean, and these guys ended up on the streets because they failed to break the market manipulation rules. That's what that film was about. Interesting. But this led to many rules. So EMIR and REMIT. So EMIR, for those of you who are not familiar, is a rule around the reduction of systemic risk. It arose out of the G20 summit of 2009, together with the Dodd-Frank regulation and many others around the world. And it involves things like having to report derivatives trades to a trade repository, and it applies equally to those who are not financial companies as to those who are. So it's consumed a lot of time, especially in the earlier parts of the 2010s. REMIT is an energy-specific regulation around market abuse, which for those in gas and power has also taken up a lot of time as well, etc. We also saw MiFID II. MiFID II was partly a result of the financial crash. It's an update of MiFID I, obviously, and was quite a wide-ranging piece of financial legislation. And one of the things it did in the commodities industry is it threatened to turn a lot of commodity traders into investment firms. So it removed a blanket commodity dealer exemption that was available in MiFID I. Instead, commodity dealers who trade any sort of derivative at all must rely on something called the ancillary activity exemption, and most do. And most have remained outside of financial regulation. Some have gone in, and that's a very important thing to think about as you see us progressing through this presentation as well. We also had have the market abuse regulation, which for those in other commodities will also be aimed at those trying to abuse the market, whether through spoofing or insider trading or other things as well. And generally, there are just many other rules, including updates to those rules as well. So we are halfway through the EMIR refit process at the moment, where those rules are changing. We had one lot of changes in 2019, and in just over 18 months we'll see a big change to reporting, and the other rules update as well. And we also have Brexit and things like that as well, that just makes life more interesting by replacing one set of rules with two that are slowly diverging as well. So that all keeps it interesting. So that's where the rules came from. We had an era of lighter regulation. Then from 2009 onwards, we had many new rules. And from, let's say, 2018, it all seemed to settle down a bit after MiFID II came into being. And we just had an era of making the rules work through refit changes. We had all sorts of fines under the remit regulation, the anti-abuse regulation that applies to gas and power. We continue to see many fines there, although not this year so far. We have the MiFID II quick fix that's come into law now. That actually watered down MiFID II a bit, including the parts that apply to commodity traders as well. By reducing, for example, the scope of the position limits rules and other things, and making the ancillary activity test easier. Green rules, we've got all sorts of new initiatives coming out from both the EU side and the UK side. For example, the Fit for 55 initiative and legislative package, and the hydrogen and decarbonised gas package, and all sorts of things like that, and just lots of updates. So we had this era of making things work. But the question is this crisis now going to lead to the next lot of regulatory stuff to do? And I would argue that it probably will, although it's hard to predict the future. So as I said, there's been no criminal sanctions yet under remit, which is interesting. We haven't seen all that many in Europe anyway. It's different in the US. In Europe, we haven't seen that many criminal cases around commodity trading yet, but those rules are beginning to bite. So you can see some of the places one can go to if one breaks those rules on this slide. It's all quite exciting. So where did this last wave get us? Well, under MiFID II, we had a very complex test in order to remain outside of financial legislation. Most did. It was quite a complicated test, so this quick fix that I just mentioned has been simplified. Okay, so that's good. MiFID II also had mandatory position limits on any commodity derivative contract on a venue in the EU or in the UK, whether it's in ags or any commodity at all, and that became quite cumbersome. So the scope of that has been reduced in the EU in one way and in the UK in another way, and replaced with stronger venue position limits rules like we have in the US. And there's other rules that I won't go into around algo trading that are in force as well under MiFID II, which apply whether you're an investment firm or not in commodity trading. Under EMIR, we have something called the clearing threshold under EMIR. Now, this is where it gets interesting. So if I am a non-financial counterparty, which most commodity traders are, and I'm underneath this clearing threshold, I'm considered less systemic, and some of the parts of EMIR don't apply. For example, the uncleared margin regulation, or a lot of parts around clearing, which consume a lot of capital and margin. So that's quite interesting, and hold that thought. There is a large change coming to reporting as well. But as I said, most commodity traders are outside of the scope of the clearing and margining part of EMIR. Then under MAR or remit, as I said, there haven't been many large fines, but there are various jurisdiction issues under MAR for non-energy commodities as well that I won't go to. But we see regulators, as always, and increasingly looking at us more and more. So, by the way, the key to that is that the yellow ones are market abuse and the white ones are about systemic risk, and I'll come to that in a minute. So, did the regulations work? That's the question. Well, here are some interesting news articles recently. So first of all, we know that the oil price went negative a couple of years ago, and there's a big market abuse case going on there at the moment. This is an article from Bloomberg that appeared last week, and there's a CFTC case as well, against several traders with chat room scripts and things like that in the case as well, around what happened when we had that negative pricing 2 years ago. So that means, did the market abuse rules work? Well, yes, there is legislation in order to do something about that. There's the report from the CFTC relating to that incident. On the energy side, interestingly, the common thinking in terms of the high energy prices and whether that's due to market abuse is that it's not, and I would agree with that, in that the reason we have energy price spikes at the moment is because demand is high and supply is low because it's being restricted from places like Russia. Well, that's how a market works. So it doesn't mean it's because it's abuse. Prices are high because there's not enough supply and not everyone wants to buy it. So that's what a market is, at the macro level anyway. And ACER, who are the agency that's a part of the EU based in Ljubljana that supervise REMIT, wrote that report. So we have that. And we have various other cases as well going on. On the systemic risk side, as we've heard, the big margin calls that we've seen have led to some asking for bailouts and things like that. And we saw an article and reports that, for example, the ECB have turned down energy traders' requests for financial support and things like that. We also saw the incident on the LME to do with the nickel price as well, and investigations going on there. So there is all sorts of scrutiny on the market in terms of A, market abuse, but B, it being the commodities becoming a bit more systemic as well. But what we see on the other hand, and this is where it gets interesting, is that there is currently a review going on of the EMIR clearing threshold. And I'm going to come to that in a minute, because there is a desire for that clearing threshold to be raised because people are in danger of breaching it. And what about that? Well, people are pushing up against this threshold in the EU. The original reason they were pushing up against this threshold is actually because of Brexit and a non-recognition of the LME and ICE Futures Europe by the EU in equivalence terms of those markets, which means under the EMIR rules that if you have a position on that market and you're in the EU and it's not a hedge, it counts towards your threshold. So that led to a review of the €3 billion threshold. And the justification for the review is A, that these exchanges aren't recognised and it might push people over this threshold, which means that they'd have to do more margining, and B, that it's actually lower than the equivalent rate in other jurisdictions in the US and Singapore. So people are pushing up against that, A, because of Brexit, but now because the gross notionals are going up as well, because of prices as well. So there's a little summary of how one does the calculation. So that happened, as I said, because of Brexit and also because of the increased prices. So we had this ESMA consultation around the threshold level. Now what's interesting around that is that although the reasoning for it is, in my opinion, sound, let's go back to the perception thing for a minute. How does the outside world perceive our industry? Well, to me, what it says is, albeit for good reason, on the one hand, we are being seen as more systemic and asking for bailouts as a commodity industry as a whole. And on the other hand, we're asking for an increase in the threshold, perhaps, or desiring that, because it shows where the systemic threshold is. Now, there are very sensible reasons for that, but there is the question of how that might be perceived, and that's something interesting. But on the other hand, we're seeing the problems that arise out of large margin calls that are happening anyway. Just think about what it would do to the industry if we had to comply with more of those. So there's an interesting balance that we have to maintain there as an industry between those two things. And we've seen, so thinking about what's going to happen in the future, there are all sorts of market interventions turning up at the moment. So we had the nickel price spike. We'll see what happens as a result of that. There are in the energy markets various discussions going on. There's an EU initiative going on at the moment in terms of market interventions in gas and in power. There's all sorts of regulations being rolled out, particularly in Germany, but in other places as well, around a required level of filling of gas storage facilities. It's not quite clear how that works yet, but there's a lot of talk of that. As I said, there's various proposed central bank interventions or desired ones in commodities markets going on. And also, we need to somehow compensate for the drain in liquidity, as we just heard in the panel. There are many who are not trading at the moment, so that leads to problems in itself. So we can see lots of regulations coming out of those, and we'll probably see lots of enforcement, more enforcement coming out as well. There will be the usual churn of market abuse cases. I would have thought that in a couple of years' time, we might hear the results of any investigations that go on because of the volatile periods we have now. Moving to other rules as well, things like sanctions rules and things like that. Obviously, if you are in the area of sanctions at the moment, you're going to be quite busy. And we can see a stricter enforcement of that as we've also heard, voluntary increases in the sanctions rules as well by firms who just don't want to deal with other firms, whether it is legal or not, just because they feel that they shouldn't. We'll see stricter KYC processes in terms of onboarding counterparties, and most importantly, a scrutiny of the markets by the public. And that's important. That really drives how things go and how politicians push things. We saw many rules coming out last time from the banking crash, and that's partly pushed by public perception. We also see a push around ESG and other green factors as well, pushing the market and the regulations as well. So there's all sorts of rules coming out around those too, some of which support the development of the market and some of which stop problems. So what could the future look like? Just to conclude, it's supposed to be a short talk. A, we'll see changes in the markets, I think. B, in terms of the position limits rules, and one thing I haven't mentioned up till now, but we did mention is we will no doubt see increases in food prices and things like that. And the position limits rules that we have arose out of the food price bubble of a decade and a half ago, which happened to happen at the same time as the rulemaking. So it found its way into MiFID II and Dodd-Frank and the other rules. I suspect that if we get more increases in food prices, we will see more legislative activity around that as well. We'll see more certificate schemes and things like that coming up as well, and all sorts of the consequences of that. Something that's important is systemic regulation. And there was an article, a couple of articles that came out about that a couple of days ago. As I mentioned, there was a push coming up to 6 or 7 years ago now to alter MiFID II, when MiFID II came out, so that more non-financial commodity traders will be financially regulated. And that did not result in the end in that many firms becoming financially regulated. But you do wonder whether there might be another push now for that. And again, there are very good reasons not to do that, but public perception is very important there. We'll see the push for green, which will lead to a change in how regulations work, and a lot around sanctions and KYC laws as well. And what we'll also see is ever more enforcement by regulatory agencies against people as well. So we'll just see quite a large push there, I think. So the world of the regulatory consultant, I suspect, will be quite busy over the next few years. And again, the thing to remember is public perception at the high level drives all of this. It doesn't always make sense, but it drives all of this. So again, I mentioned trading places before, but just think through how the public perceive us, both as traders and in the commodities industry as well. You have all these different excellent movies around our industry, and none of them look at the fine detail of how it really works and why regulations should be a particular way. That's what drives us. There's another one there. They just carry on. So that's how we are perceived. So in conclusion, therefore, my view is we are in the midst of the next defining event in the world of regulations. And certainly again in my world, I think that when the dust starts to settle a bit on what's happened, we might see another round of rulemaking to think through security of supply, considering or assuming that commodities markets are perhaps more systemic and fundamental than they were considered to be before, despite the fact that we are dwarfed by the financial markets, and we'll expect more rules on how the markets operate, position limits, sanctions and KYC, and perhaps attempts to make traders more systemically accountable. I don't know. We'll see if that happens. More enforcement, etc. And so, in conclusion, I think we need to remember how the outside world sees us, and we can expect on the regulatory side to be very busy, which I think we already are. Any comments or questions on that? Yeah. That's a good question. You mentioned unintended consequences. This was going to be my closing thing over there. So do I see any hope? Yes and no is the answer. So until what we saw last year, and actually it was triggered to a degree by COVID, was certainly in Europe, and I'll talk about MiFID II here, a lightening of the burden that was introduced. And there was a recognition that some of those rules, also on the Basel side as well, in terms of a change in the prudential regulations and things like that, there was a recognition that perhaps it was too burdensome, not only on non-investment firms, but on investment firms too. So I did have a bit of hope, and I think that some of those revisions were quite sensible. But when there's a new crisis, the wave starts again. And my worry is actually that the next crisis will lead to new unintended consequences, as they always do. Because again, the direction of the regulation comes from politicians who, on the whole, do not understand the detail. And so, yes, so I was in your talk yesterday, actually, when you talked about how many paragraphs there were in Basel II to do with commodities. And in the revision, I think it was none. And in the original one, it was twice or something like that. Yes, and then in the revision, there were none, I think. Yeah. So first of all, in terms of... so some things will happen and some won't. I think that the crisis will no doubt precipitate rulemaking. And as always, there will be unintended consequences from those. And yeah, we must lobby. Yes. Yes, indeed. So yeah, we have that. But on the other hand, on the other hand, one of the issues we have is that commodities in the past are seen as just this asset class on the side. That's not the case in this crisis. So I don't know if that's good or bad. Yes, Shally. But yeah. Oh yeah, yes, I do. I think there'll be a lot. Again, because this crisis is centred around commodities, I think there'll be many suggestions like that. And to also answer the question, yeah, I mean, I think there has been lobbying. So, I mean, there was some successful lobbying, I would say. So, more on the energy side, we have organisations like EFET, who do carry out some sort of, well, industry representation. And to some degree, there was some success in changing some of those directions. But So yes, so as I said, there are attempts at doing that. We shall have to see. We can only shape it as best we can. Thank you. Any other? There we go. I mean, I hope not. I think that there is a recognition in most places, including actually at the EU level by DG Energy and those guys, that nationalisation is the wrong answer. So hopefully not. What else can I say? There are these calls for market interventions in certain EU member states. It hasn't been adopted at the Commission level as far as I know, but they will come out with something. But I would say hopefully not. I think certainly if you go around the energy industry, there is consensus that the nationalised days, which I vaguely remember, but before I was working, didn't make things any better. It didn't make things any better. And as far as I can see, again, my view is that the high prices we see in energy are a result of not market failure, but the opposite. It's just a reflection of the fact that the commodity is scarcer and therefore it's more expensive. And so what do you do when something's more expensive under a non-planned economy? Well, you can either buy less of it and moderate your demand, or you can not spend the money on something else. And in the medium term, you can sort out the supply or reduce your demand. That's just how a market is supposed to work. If you go to a planned economy, you end up with rationing. It's just basic economic. That's not specific to energy. You could argue the same with food. Maybe we should have fixed food prices and ration it, but that's not. You can argue whether that's a successful model or not, but it's not really specific to commodities. So I think it's nearly lunchtime. So if you want to find me again, I didn't put my contact details on, but I have a blog. I didn't put the actual contact details. That was silly. So www.energytradingregulation.com or ETR Advisory. I write a blog on regulatory developments in the market, which will probably be on the website of the conference. And I also commercially offer regulatory support for all sorts of people as well. If you want to find me, I'm here. All sorts of resource libraries and things like that in the various places as well. But that's me. And yes, apologies for not putting the contact details on. I wrote this while I was on holiday, actually, last week. So that's my excuse. So, yes. But thank you, everyone. And enjoy lunch.